Welcome to the NDIS Property Australia podcast. Before starting this episode, we need to provide a general disclaimer. Information contained in this podcast is general in nature only. It does not take into account the objectives, financial situation, or needs of any particular person. You need to consider your financial situation and needs before making any decisions based on the information in this podcast. And you should consider seeking independent and professional advice for your personal circumstances. All right, let's begin.
Hi everyone, welcome back to another episode. My name's Eryn and I'm here today with Minh and Matt. And we're going to be discussing a list of inquiry questions that we got from one of our investors that's been sent to Matt. So yeah, let's just get straight into it, I suppose.
So Matt, is there a background story here on this client?
Yeah, so this was a client who called in with obvious an interest in purchasing an NDIS property, but based off the original conversation with this client, we went over a number of things, and they've sent through some questions that they wanted clarified, and they're very in depth. So we thought we'd use this opportunity just to obviously give our answers to these questions, just to allow other people to learn a little bit more about investing in NDIS properties.
So Matt, is this your way of saying you're too lazy to actually type the answers down and put in a podcast instead?
It's like sending a voice note. All right.
Eryn, I'll just start with questions.
Yep. So question number 1, my wish for this investment is to have a strongly positive geared investment once participants have been found. With your past clients, how frequently do they achieve this? Do they achieve this even when accounting for mortgage interest payments? Have your past clients been happy with their end result?
I think most of our clients have all started their construction. So no clients have actually finished anything. We have 2 clients coming up for a close to completion at the moment, but we haven't gone through the whole process yet. Remember, NDIS is brand new in Australia, so it's a bit of a journey at the moment. So we can't really comment on that other than we're going through the process right now with all our clients, yeah.
Yep. All right, anything to add, Matt?
I just say, it's based on their relationship with their provider. That's kind of where that relationship is more around the provider and the client, as opposed to the build side of things.
Yeah, 100%. All right, question 2. With the expenses included in your stock list and feasibilities, does this include expenses paid to the provider? While on that subject, what are the fees and charges of the provider? Looking at the stock list, expenses annually seem to be around 20%, and that's before mortgage interest rates.
Correct. Before mortgage interest rates, yes.
Yep.
The provider fees are always different, aren't they, Matt?
Yep.
But they're around about 10, 11, 12%. So 11,
12%, but it also depends on the provider that you go with. So we have a recommended provider that we work with, but you can go with a different provider if you so choose to.
And also, Matt, sometimes other providers are specialising in a certain area, like Sydney and Melbourne and Perth. And if our main provider cannot work there, then we'll recommend someone closer locally in the area, yeah.
Yeah.
Yeah. So in terms of does the expenses include fees paid to the provider? Yes, it does. Yeah. 100%. Yep.
Yep. Cool.
A part of the other expenses also would be council rates. There's also been an amount allocated towards maintenance.
Insurance as well.
Insurance.
Yeah.
And that's all included in the feasibility?
In the expenses.
Yeah.
Yeah. Okay, number 3, how often does your stock list update? How do you decide which category of house to build on which block? On your stock list, the category of house has already been selected for the block, which I was surprised at. How does that work?
Matt?
So I would, obviously our stock list updates very frequently, whether that's people purchasing or us adding new stock. We work with a number of builders all around Australia.
It's more like once or twice a week is how frequent, yeah.
Yep.
Yeah. So the builders normally specialise in a certain build, like HPS or Robust or IL. So the builders normally select that design category on that block there.
Yeah.
They normally select also the best, I suppose, design for that block, given the specifics of the block and what would be most suitable either from a point of it complying with the legislation in regards to it being approved as an NDIS property, or in terms of what's best to build on the block based on the builder's opinion.
I also want to add we are very bullish on improvability as a design in Perth at the moment, because we're knowing how much other HPS is being built in the area. So we are avoiding HPS where we can and going towards IL. With Melbourne, we're very focused on robust homes because, number one, the blocks sizes are limited in terms of size to be able to do HPSs.
Yeah.
So 2/3 IL and 1/3 HPS. So that it comes back to block availability, also builders' preferences. Yeah.
I guess another good example would be, in terms of like picking a block, would be the requirements for just a HPS, like the angle of the block.
Yeah, so it has to be a very flat block.
Yeah.
Very, very flat. It also has to have 15-metre frontage to build a HPS.
12.5 minimum for any SDA,
that's for
but
IL,
but I recommend 15 for HPS, yeah.
Yeah.
So block sizes, yeah, for sure. Next question.
Question 4. The construction costs on the stock list seem a little expensive. Are these NDIS houses a little overcapitalised when compared to similar non-NDIS properties on the open market, or are they comparable?
Yes, and yes. So yes, they are a little bit more expensive. Yes, they are overcapitalised. Are they? Well, yes. And then are they comparable? Well, comparable is in the eyes of the buyer, I guess.
Yep.
The valuers, financing the valuers, they will decide whether it's worth money, the money it's being paid for, I guess. And prices are going up all the time because of supply chain and lack of labour shortages, I guess, yeah. It is more expensive. So I reckon you can say that an average HPS house is probably 150 to 200 grand more than normal house.
Yep.
And a robust house is probably 100 and 150, 100 grand more than normal. So, but we're working everywhere in Australia at the moment, so the price is always fluctuating everywhere at the moment, yeah.
Yeah. So question 5. Once an NDIS house is fully tenanted, I think that's meant to say, is it worth more? Does its value increase, similar to how industrial rentals work?
Yes.
Well, yes and no.
I would say yes in terms of the value it has to an investor.
Yes, correct.
But
From
the
my
actual value of the property itself
doesn't change overnight because there's someone moving in. No. So there's value to actually having a house fully tenanted, having rent coming in, but you're not going to get a valuation uplift next month because there's 3 tenants in there.
Yep.
No.
Yeah.
Correct. Yep.
Next.
Number 6, similar to the above questions, how do banks form valuations for these NDIS houses? Are they compared to similar non-NDIS properties on the open market, or are they valued differently?
They're valued differently because the valuers are using a commercial rent formula, and they normally come in within 40, 50, 60 grand variance of the contract price.
Yeah.
2 years ago, it would have been 200 grand short. But now they are valuing it pretty close to the contract price, if not on contract price, Next.
Right. 7, how quickly do your past clients generally find participants? This is to say, how long might the property not be rented or only partially rented for?
So all our clients are going through the whole process right now of construction, so we're not there at completion yet. So the goal... Our advice is, and as per everyone else's advice with who are in the provider game, begin the process of procurement of participants early in the piece. Don't wait to the very end.
Yeah.
So start 8-9 months prior to completion. So as soon as your construction then is settled and construction begins, that's when you engage a provider to source participants for you. That's if it's not participant led. So, but the answer is, I think a good, from experience with another provider we've spoken to in the past, they say that if you start a year in advance or 10 months in advance, then hopefully you should have your first tenant in month 1, your second one in month 2, and your third one in month 3. Yeah. So 3 to 5 months is the time frame to fill the house after completion. Yeah. Even with waiting a year in advance. Yeah.
Excellent.
I'm pretty wowed by the max yields that could be achieved. However, during our phone call, you mentioned that 60% of the max yield is a good figure to go on. More realistic, right? Would this put many of these NDIS houses into a neutral geared situation rather than positive?
Yes. because, our investors want to see what the maximum yield return is for if it's fully tenanted house.
Yeah.
But we always make it very clear, do not ever assume that all the time.
Yeah.
Because in our feasibility, we show a different...
we show tenancy mixes in our feasibility just to break down the possible scenarios that could arise. So in a HBS house, if you're listening and you're not aware of this, you can have FA or IL participants. So that can result in you having a number of participants in the house with different funding amounts, which ultimately gives you a different yield and a different cash flow.
Yeah. So more on that, Matt. If you have a large enough house with large enough living spaces, living room, a fresco, and a media room, there's enough space for them to have more tenants in the house.
Yeah.
It's not congested if it's a small house.
Yeah.
So that allows you to have up to 3 participants. But if you have minimal space, you may have only 2 participants. 2 out of 3 is 60% of the actual rent there. So that's the first thing there. Second factor is the tenancy mix of IL and FA and HBS mixed together as a combination. So do not ever assume a maximum rent. Assume 50 or 60%. Even at 60%, Matt, that's still going to be 8-9% yield.
Which is great.
Which is still above neutral. Neutral is going to be 4 or 5%,
Yep, absolutely.
So it's slightly above neutral.
I tell people that if they're happy with that amount, if they go conservative, as we just mentioned it, say 60%, 50%, 60%, 70%, if they're happy with that amount, then this is a good investment option for them.
Yes.
Yeah. So next question. Once you get a participant, will the investor generally be paid the SDA base rate on the table?
In the table.
Or in the table?
Yeah.
Oh, in the FISO table.
Yes.
Or do the participants often negotiate a lower rate due to their own budget constraints? For example, lower SDA funding for the individual participant.
No. The rate's not negotiable. It's paid by the government, from the government to the provider to the landlord.
Yep.
So it's not like that. They don't pay it.
The participant doesn't have really a part in deciding to negotiate at all.
Yeah.
No.
Yeah, it doesn't work like normal rent.
No,
It's just like a set.
Government-funded scheme paid by the government, not anything else,
Yeah. So question number 10. I notice you've got one house on your stock list that is already built. Just curious, how did that happen without an investor?
That's your Exception Bay one, isn't it, Matt?
Yes. Yeah. So sometimes we're approached by people who are interested in selling their NDIS properties. So that's when typically we'll have a property that arrives on our list that's already constructed. So most of our houses are fresh builds, but occasionally we do have the odd property that comes through that's already constructed.
Look, the reasons why people resell a brand newly built house for NDIS could be a number of reasons. Number one, it didn't work out the way they wanted and they went out. Number two, they believe in a hot market, they can get a higher price to resell, which is common.
Totally fair.
That's normal
Yeah.
everywhere at the moment.
Especially at the moment.
Number three, a change of personal circumstances. The mothers have lost their job or their wife is sick or something in their family.
Yeah.
That's the third reason. They're the reasons why,
Yeah, so it didn't really happen without an investor. It was just he paid for it to be built and now he's wanting to sell.
At a higher price,
Yeah.
He's a retiree, by the way, so it's fair for him to get out at a higher price.
Yeah.
It's quite normal,
Yeah. So number 11, when choosing land from stock list, would I get to view the land in person? Also, I would want to know the soil rating since I've had trouble with reactive soil and subsequent erosion in the past. And I would also want land that's not sitting on fill. Is that doable?
So it depends on the area, the site. Normally the builders would get information from the land developer with the soil tests and they'll work on the pricing based upon the soil tests. So the builder will also do an actual soil test after land settlement as well. Does that really answer the question? Yeah, I guess so. We'll do our best to provide this whole information to this client on the land he wants to look at buying. Viewing in person, I guess, so he can view in person if he can, if it's actually there to step on.
Yeah.
But if it's not ready yet, entitled yet, you can't really look at anything. If it's 4 months away, 5 months away from completion,
Yeah.
So that's the answer.
So next question, do you perceive any issues getting the house constructed in the near future? The news is saying the building industry is struggling.
Delays. There's been plenty of delays the last 6 months.
For sure.
Especially land releases.
If you read the press, people could be waiting a year before start construction. Our evidence with all our buildings across Australia is about 15 15 months build time frame in total.
Yeah.
From site start. Remember, 3-4 years ago, it was a 4-month build time frame. Now it's 15 months.
Yeah.
So also, everyone, the war in Russia and Ukraine,
Yeah.
right? That is affecting big time the construction of Australia. There's a veneer timber type of product that comes from Russia.
I don't even think it's just Australia anymore. I think it's affecting multiple countries.
So I was reading an article on the weekend. Now, Australian double-story houses being constructed require the special hard veneer timber from Russia.
Right.
Because of the sanctions that happened over in Russia now, nothing on in or out.
Yeah.
Double-story houses cannot be done efficiently and quickly enough. So it's very slow. Conflict timber, higher prices.
Yeah.
I don't know about alternatives. So the overall war overseas and other problems overseas is definitely affecting.
Or even just problems in Australia like floods, COVID.
Yes.
Everything, weather, anything.
Labour.
Timber shortage, yeah.
Number 12, what house type generally yields the best results? For house type, I was thinking a 4-bed house, but you have to leave one room free to get OOA rent, right?
Yes, you do. Yep. So one essentially room in the house is for the OOA. That's the overnight on-site assistance or the carer. Which type generally yields the best results? That's a bit of a different.
No. I wanna break this question. Yields the best results. The word yield is different from the best. So by definition, the best results is different from the best yield.
Yeah.
Which is different from the best cash flow. So I'll give you 3 answers. If you're after the best yield, you're better off to going with robust design homes.
Yeah.
If you're after the best cash flow, you're better off going after HPS design homes. If you want the best results, probably a improved livability home because it's lower risk, lower bill price.
Yeah.
And 70% of the market is IL category design participants. So it's a different answer depending on what the client wants. So risk profile, budget, cash flow, or yield, it'll give you a different answer. So it's an open-ended question, I guess. Yeah.
In saying that as well, though, like you can build a HPS house and get IL.
Yes.
But you're paying more
a lot
for
more.
the HPS house.
Yes. Correct.
Yeah. 13. What house category generally gives you the best ROI? For example, I noticed the base rate for FA is about 30% more than IL, but robust is only 15% more than FA. So depending on the cost to build each category, you might get a higher ROI if you build a cheaper house. In this example, that would be FA. Since building a more expensive house like robust doesn't give you a huge amount more rent. Or am I not understanding something when it's quite likely?
Okay, so I would love to answer this complex question. It seems like the 2 paths, of the 4 paths in front of every investor, IL, FA, robust, HPS, the 2 paths that people are taking is either robust or HPS.
Yeah.
The reason being is HPS and FA is almost identical. Apart from a solar panel and the battery backup of the house, which is 30 grand only difference. You might as well go HPS if you're down that path there.
Yeah.
It's almost the same price.
So it becomes either IL or HBS.
No. That's the HPS FA, HPS, almost identical price.
Yeah.
Robust and IL almost identical as well, because the design for layout is almost identical, other than
the thicker walls.
The high impact walls.
Yeah.
So for an extra 40 grand, 50 grand more, you might as well go robust.
Yep.
Because the robust house brings into account the following tenants: robust tenants, IL tenants, or a normal family.
Yep.
Okay?
Yep, exactly.
With the HBS house, design house, the 3 tenants are HBS and or FA and or IL.
Yeah.
So they're the 2 paths there of the 4.
Yep.
So for an extra 30, 40 grand difference in price for these 2, you might as well go the extra.
Yeah, because it opens up your options so much more.
So to answer the question, best return on investment. So is it about diversification and lowering risks, or is it about ROI? So go back to my last answer. Robust and IL is still pretty good.
Yep.
It depends on the price, the cost price to build it.
Yeah.
So does that answer the question, Eryn?
Yep.
Yeah, probably, but just...
Yeah, it is more expensive. Yeah. It comes back to budget. What can you afford to buy, and what's the reason why you're doing this? Because if you're gonna, if you want to have lower risk by not having a vacant house, then don't go HPS.
Yeah, I think the question is that it's more expensive to build a robust or a HPS house, which doesn't give you, a really insane amount more rent, but it's lower risk because you can get more types of tenants.
Yeah.
Yep.
So we have one builder in Melbourne who'll do the hybrid house, which is all 4 categories in one house. They're very rare, but they can be done.
Yep.
For an extra 30 grand more above the HPS. So different areas, locations around Australia will have different location factors, which adjust the income.
Yeah.
And different build costs. So there's all these different varying factors which come to play in our recommendations to our investors. And because we're active out there in the marketplace everywhere, we're able to understand what the prices are and the volume of build pipelines coming out. Yeah.
Yeah. And then number 14, this is the last question. Of course, it would be amazing to nab a couple of HPS participants, but how likely does this actually happen? I remember you saying only 10% of the market makes up these and a whopping 70% of the market makes up IL.
Matt?
I would say, it's certainly possible, but I feel like there's a lot of, misconceptions in the market, particularly from other companies, which indicate that you're going to get in a 4-bedroom house, you're going to get 3 HPS participants, which I think is unrealistic, and we think is unrealistic. So I think you might get 1 or 2, but just being aware of the fact that you probably won't get 3. You probably won't get all your participants being in that HPS category.
Yeah.
In an upcoming episode, the next few weeks, we're going to do a podcast about research analysis, what software, what data, what research material we use to help guide people. Now, to answer this question, really comes back to a couple of things: location, builders, what's being built in the market in that area already, the total participants in the NDIS in that region, right? How many are already funded and are not funded? Like, there's all these factors which are still being sorted out in the background.
Yeah.
If you're able to find a provider with 2 or 3 participants who are already HPS already funded, brilliant. That's almost like a guarantee.
Yeah.
But even still, by the time it's built in a year's time, there's no guarantee they'll still be there.
Yep.
So you find them, but they could be gone in 6 months. So it is a roll of the dice sometimes, because you can't. How do you ensure that they're going to be there and move into your house? You can't be sure at all. And
also going forward, after you've already had the house, going into the future and retaining them,
they can leave after 90 days. So even though you sign up a 1 or 2 year lease, they have the right to terminate in 90 days and move out. What do you do then? So that's why our approach to our advice and our guidance to investors is lower your expectations, assume a diversified tenancy mix of IL, FA and HPS. Do not assume the maximum rental yield and gross return, and be aware of potential vacancies at the start or at somewhere in the future.
Yeah.
When there's more stock coming online in the area.
Yeah.
So to future-proof your house, your property for SDA, you need to make it more different, because like every other tenant in the world out there, they move around to different places if they see a better product out there.
Yeah.
Yeah.
Yep.
Yeah, and we have spoken about like future-proofing before.
Yeah.
In other episodes, especially the one with Kim Johnston.
Yes.
Yeah, that one's a really good one to go off in terms of
absolutely
knowing how to future-proof.
Yeah.
But that is all the questions from your client, Matt.
We've done well to wing all those answers out.
Yep.
But yeah, it's great to have have this session today, because we're just able to answer in one session all these questions from someone else.
Yep.
And it shows our listeners that these are the kind of questions that are being asked.
And hopefully that helps out some people out there who might have these questions as well.
Yeah, because we could have just, you could have just responded to the email with the questions and answers. But speaking about it on a podcast really helps other people who might have the same questions.
Yeah.
So I think that about covers it.
Yep.
Matt, any more bits of advice following on from this person's questions to you?
I think I feel like I say it every time, but just do your research, and just try to learn as much as you can, because it is a very complex subject. So obviously asking all these questions and being open to different answers and learning more about the industry and SDA properties. It's so important.
Yeah.
My last bit of advice is, whatever you think you're hoping to achieve, halve it. Which is close to what you said, 60%, right?
Yep.
And if you're okay with 50% of the number, you're okay with that number?
Yep.
And that covers your costs and your mortgage payments, then...
Go ahead.
Because only time will allow the other participants to drift in, to move into the house.
Yeah.
And get the participants you want.
Yeah.
So don't expect everything in the first day at completion. Yeah. It takes time.
Yeah.
Because participants want to touch and feel the house before they move in.
Yeah.
So you can't expect three people to sign up on a house that has not been built yet. It's just, it's unreasonable, yes.
Yeah. Yeah.
Cool.
Amazing.
Awesome.
Thank you.
Thanks, Eryn.
Bye-bye.
We hope you enjoyed this episode. Please make sure that you are subscribed and following us so that you can keep in the loop with all of our upcoming episodes. We would really appreciate it if you could leave us a 5-star rating, a written review, and to share this episode with those that can benefit. Until next time, catch you on the next episode.